Analyzing candlestick formations. This segment builds on the discussion of candlestick analysis begun in starting with candlesticks and is designed to further your understanding and ability to apply candlestick information to your technical analysis of the trading markets. The principal use of candlestick analysis is in spotting near-term reversal opportunities. There are numerous types of candlestick formations and patterns that often lead to significant reversals in a stock's price. This segment focuses on some of the most important one-day formations that you need to be aware of. Each of the types listed here are covered in this segment. A doji candlestick is marked by a very narrow difference between a stock's opening and closing prices. In many cases, the price may close at the same price it opened. This produces a very flat horizontal line in place of the normally expected candle body. Another visual indication of a doji candle comes from a shadow on either end of the body, roughly equidistant from the body itself. On the right, you can see three good examples of common doji formations. Doji candlesticks are significant in that they signal uncertainty in the current direction of a stock's price. During an upward run, it is customary for buyers at some point to exhaust their resources in buying the stock, just as sellers eventually run out of supply to liquidate in a downward run. In these cases, the stock will often hover or vacillate in a general price area, while traders reevaluate market conditions and decide what to do next. These uncertain conditions often result in doji formations. By itself, a doji candlestick doesn't signal an immediate reversal in price, but only that traders are uncertain as to the next step the stock will take. For this reason, at least one additional candle following the doji is usually necessary to determine whether a reversal of direction or continuation of the current trend will occur. The chart shown here has numerous doji formations scattered throughout. You can see them indicated by the arrows. Notice that the occurrence of the doji candle is often followed by a change in the stock's direction. Although the change isn't immediate, it often follows within 1 or 2 periods. Take a moment and look over the chart. Are there any other candlesticks besides the one pointed out on the chart? This is a good example of a doji candle that preceded an upward reversal. Note that candles that open and close at or near the top of their candle shadows look somewhat similar to a doji, but in fact are not considered doji candlesticks and generally have a different implication. We will look at these types of candlesticks later in this segment. A spinning top has a larger candle body than a doji, but is still marked by a relatively small difference between a security's opening and closing prices, along with a shadow on either end of the body. Doji candles and spinning tops are similar in other ways besides their physical appearance. A spinning top signals uncertainty in the same manner as a doji candle. Although the difference between opening and closing prices is greater than that for a doji, the shadows on either end of the spinning top provide a good indication that neither buyers nor sellers were able to decisively seize control of the stock during the period. Note that the indication of uncertainty is the same regardless of whether the candle is filled or open. Also, in the same fashion as for a doji candle, at least one additional candle formation is required to confirm or signal whether a reversal will actually occur. On this chart, we have pointed out several occurrences of spinning tops. Notice that a reversal in direction often follows, while in other cases the price simply continues to move in its current direction. There are a few other instances of spinning tops on this chart we haven't pointed out. Take a moment now and see if you can identify them. We can see additional formations at various points on this chart. Notice also that in some cases, the shadows on either end of the body are much shorter, while others are quite long. Although the longer shadows indicate a wider trading range during that particular time period, both types are considered as having equal strength, since the security ultimately finished the period very close to its opening price. A hammer is one of the strongest one-day reversal signals. This type of candle can be seen during both upward and downward moves, but is only described as a hammer when it occurs in a downturn in price. This candle is marked by the small candle body and long shadow below the body. A small shadow may also be seen above the candle body. The reason a hammer is taken as such a strong reversal signal lies in the nature of the price movement. The price opens and drops, but after experiencing a significant drop from the opening, buyers jump back into the market and push the price back up close to its opening price. The actual closing price may be somewhat higher or lower than the opening. The important information comes from the rally prior to the close. This bullish push late in the period often provides upward momentum that continues for multiple following sessions. This chart gives a few different examples of hammer formations following downturns in a stock's price. Note the momentum that continues for multiple periods. This is a common occurrence when a hammer appears, as buyers storm back into a stock and push its price higher. Take a moment and review the chart. Are there any other occurrences of a hammer formation that aren't already indicated? These two occurrences of hammer formations provide additional opportunities to buy at cheaper prices prior to significant increases in price. The hammer formation is a candlestick you will want to become proficient at recognizing as you perform your technical analysis. Like the hammer, an inverted hammer formation is also considered to be a very strong indication of a bullish reversal, and it occurs following a downturn in price. It is probably not as strong as a hammer and follows a different logic. After opening, the price moves higher only to be pushed back down to or even below the day's opening price. The bullishness of this candle lies in the fact that prior to closing, buyers came back in and began buying enough to keep the price from dropping even further, in effect stopping the bleeding. In a downturn, this candlestick often signals a point at which sellers have run out of supply to keep liquidating, giving buyers the opportunity to enter at bargain prices. We have 4 examples of an inverted hammer formation on the chart we now see. In 3 of the cases, the price staged a significant rally to the upside after the inverted hammer appeared. As with the hammer formation, learning to recognize this pattern can give you very good points at which to enter bullish trades. Since this isn't as strong a signal as a hammer, waiting for an additional candle to confirm the new bullish momentum in price is often advisable. A shooting star looks identical to an inverted hammer, but has a much different implication. Where the inverted hammer occurs in a downtrend and signals an upward reversal, the shooting star is usually seen at the top of an upward move in price and signals a likely downturn in price. The shooting star is often described as the result of a failed rally. As buyers begin to run out of resources to keep buying a stock, they often stage a last gasp effort to keep pushing the price higher. The shooting star occurs as buyers exhaust their resources and sellers take over the period's momentum. The increase in selling pushes the price lower, so that it closes at or near its opening price. This candlestick can be a useful tool in identifying points in time to take profits in bullish trades before a more significant downturn occurs. We can see at least 4 examples of shooting star candlesticks on the chart before us. Notice that although this candle doesn't always point to an immediate, drastic downturn in price, in the first three cases the price did experience a period of gradual decline. At such a time, the price of a stock could move either up or down, depending on market conditions at the time. In such a period of uncertainty, a smart trader who bought previously would move to protect or take profits in the event of a more significant downturn, such as what happened in our fourth example. The hanging man, like a shooting star, is also a bearish reversal signal that occurs at the top of an upward run. In appearance, it is identical to a hammer formation. Remember that the difference between these two types of candlesticks lies in the direction of the current trend. A hanging man formation occurs when buyers have spent the last of their resources to buy the stock. After opening, sellers came in and pushed the price lower, only to have buyers make one last attempt to prop the price up. This last gasp effort forces the price back up to close at or close to the opening price. Out of resources, however, buyers are typically unable to continue the bullish momentum, leaving room for sellers and profit takers to begin pushing the price lower. This chart shows four very good examples of the hanging man formation. Notice that following their appearance, the stock experienced downturns that lasted for several periods afterward. The extended time these downturns can last give more than adequate reason for making sure that you can spot these formations when they occur. They can provide early signals to exit profitable bullish trades, as well as opportunities to enter bearish trades. In both appearance and application, the tombstone formation bears a distinct resemblance to the shooting star. In fact, this candle is appropriately named because it often foretells the impending doom of a current upward rally. After opening, the price is pushed upward by buyers in an attempt to sustain the current momentum, only to have sellers take over late in the session and push the price back to its opening level. This late, strongly bearish momentum typically carries into the next period and can easily lead to more significant downturns. The tombstone formation shown on this chart provide clear signals that a drawdown is likely in the near future, providing traders with bullish positions early indications to take profit and move on to greener pastures. In many cases, the downturns that follow this formation are not only extended in time, but also cover significant distance in price. For this reason, this formation should not be ignored when it occurs. Each of the formations we've discussed in this segment provides important information that can be used to supplement your overall technical analysis. In the next segment, we'll discuss how combinations of candlesticks can be used to predict future price action.